FBND won the sprint with 15% over 3 years, but SCHP's crushing it long-term at 6% versus FBND's 3.5%. Over 5 years, SCHP's 6% crushed FBND's 3.5%. That gap shows inflation protection really pays off long-term. But here's where it gets interesting. FBND crushed it over 3 years with 15% returns, beating SCHP's 12%, a clear winner in recent performance. In plain English, here's the perfect analogy. FBND's like a drag racer, explosive speed out the gate, but can't sustain it. SCHP's the endurance champion, built for the long haul and crossing the finish line first. But here's where it gets interesting. FBND's 1.1% gain over the past quarter shows solid momentum, riding the recent wave in broader bond markets. Here's where the story takes a turn. SCHP's barely there, 0.19% return, shows inflation protection came at a cost, missing out while FBND surged ahead. Let's break this down further. Both delivered 8% over 1 year, but how they got there tells wildly different stories we'll explore next. In plain English, performance is like a seesaw. FBND's riding high now with recent wins, but rewind 5 years, in SCHP was the heavyweight champion. The balance never stops shifting between these two. Now for the real question, returns per unit of risk, that's what Sharpe and Sortino ratios measure, separating true performers from just lucky ones. Let's dig into the details. SCHP's negative 0.3. Sharpe ratio means you took on risk but got nothing back, basically paying for a roller coaster that never goes up. Here's where things get revealing. FBND's minus 0.5 Sharpe ratio means you took real losses for every bit of risk you swallowed over 5 years. In plain English, think of the Sharpe ratio as your investment report card. SCHP scraped by with a D over 5 years, while FBND completely bombed with an F. Neither one's making the honor roll here. But wait, there's more to this story. The Sortino ratio cares about one thing: protecting you when markets crash, not penalizing gains when they spike upward. Here's the thing though, SCHP's Sortino ratio of 0.1 is brutal. You're taking downside risk, but getting almost nothing in return for it. Let's take a closer look. FBND's Sortino ratio of 0.4 crushed SCHP by 4 times. You're getting far better rewards for taking on downside risk here. In plain English, the Sortino ratio is all about the journey. FBND got you there on smooth highways, while SCHP bounced over potholes the whole way. Both reached their destination, but FBND's ride was way more comfortable. But that's not the whole picture. Maximum drawdown shows your worst-case scenario, how much you'd lose from peak to trough before any recovery begins. Let's see how this plays out. A 14% drop rattles conservative investors who expect bonds to stay stable. That's serious money lost when you're seeking safety. Here's what really matters. FBND's 17% crash cuts 3 points deeper than SCHP. That's real pain when you're supposed to be the safe investment. In plain English, maximum drawdown shows your worst-case scenario. FBND took investors on a steeper ride down, 17% versus SCHP's 14%. That 3-point difference? That's real stomach-churning territory when your money's dropping. But hold on a second. Recovery time reveals the real pain. It's not just how hard you fell, but how long you're stuck underwater watching others sail ahead. Let's unpack this a bit. Time to make your call. Who takes this matchup, SCHP or FBND? Here's the key takeaway. SCHP took 747 days to recover from its drawdown, over 2 years just to break even on your investment. Now let's flip the script. Nearly 3 years underwater, that's 1,050 days watching your investment bleed while you're questioning every life choice you've made. In plain English, recovery isn't quick. SCHP's storm took 2 years to clear, while FBND's dragged nearly 3. Both eventually found sunshine, but you'll need serious patience waiting out the turbulence. Let's get into the weeds here. Volatility measures how much your returns bounce around year to year, and for bond investors, steady always beats wild. Now let's shift gears and look at SCHP's volatility. At 6% volatility, SCHP is pretty steady. Inflation-protected bonds don't swing wildly, making them a calmer ride for investors. But here's where it gets interesting. Both funds swing equally at 6% volatility. No stability advantage for either one. They're perfectly matched on steadiness here. In plain English, think of it like a car engine idling. Both SCHP and FBND vibrate at the same frequency. Neither one's smoother than the other. They're basically identical in how they handle volatility. Here's where things get revealing. Expense ratios quietly drain your portfolio year after year. Small percentages compound into huge losses you'll never see coming. Here's where the story takes a turn. At just 0.03%, SCHP's expense ratio is rock bottom cheap. You're keeping nearly every penny of your returns here. Let's break this down further. FBND's 0.36% expense ratio costs 12 times more than SCHP. That 0.33 percentage point gap seriously eats into your returns over time. In plain English, SCHP's expense ratio is just 0.03% versus FBND's 0.36%. That's literally couch change today. But compound that difference over 20 years, and you're looking at significantly more money staying in your pocket instead of disappearing to fees. Now for the real question. FBND delivered stronger 3-year returns at 15%, while SCHP's 5-year run shows steadier 6% gains with dramatically lower costs. That 12 times expense difference really adds up over time. Let's dig into the details. Turnover matters because every trade costs you money and triggers taxes that'll eat into your returns over time. Here's where things get revealing. SCHP's 30% annual turnover means it holds bonds longer, avoiding the transaction costs that eat into your returns over time. Now let's put this in perspective. FBND's turning over its entire portfolio more than twice annually. That's excessive trading driving up costs you're ultimately paying for. In plain English, here's how turnover works. SCHP takes that road trip once every 3 years, while FBND is making the journey twice annually. All that stopping, starting, and refueling, that's costing you real money. Here's the thing, though. Diversification's tricky. Spread across too many bonds and you're safe but bland. Too few? You're gambling on concentrated bets. Let's take a closer look. SCHP keeps it simple with just 49 bonds. That's because there aren't many inflation-protected securities to choose from anyway. Now here's where it gets tricky. FBND spreads risk across over 4,000 bonds. That's 90 times more diversification than SCHP's narrow focus offers investors. In plain English, SCHP concentrates its bets across just 49 holdings, while FBND spreads across 4,352. It's the classic egg basket dilemma. Wider diversification versus bigger conviction plays on each position. Let's see how this plays out. Lower correlation with stocks means better diversification. Your bonds can protect you when your equities take a hit. Here's what really matters. With a 0.2 correlation to equities, SCHP zigs when stocks zag. That's portfolio diversification working for you. Now let's connect the dots. FBND's 0.3 stock correlation means it moves more with equities than SCHP. Less diversification protection when markets drop. In plain English, SCHP's your more independent dance partner here, moving to its own rhythm while FBND follows the stock market's lead a bit more closely. Neither's locked in step, though. Let's unpack this a bit. Bond investors aren't chasing moonshots. They're here for steady income. That's where dividend yield and growth really matter for sustainability. Here's the key takeaway. SCHP's 4% yield offers steady income when price growth is limited. That's the trade-off you're making here. Now let's flip the script. FBND's trailing yield hits 4.7%. That extra income really adds up when you're living off your portfolio. In plain English, think of dividend yield as couch change you actually get to keep. SCHP pays you $4 per 100 invested, while FBND pays $4.70. That extra 70 cents adds up to lunch money every month. Let's get into the weeds here. Dividend growth over 3 years shows whether your income's keeping pace with inflation or slowly losing ground to rising costs. SCHP's dividend crashed 36% over 3 years as falling inflation expectations hammered TIPS payouts. That's a brutal income collapse. But here's where it gets interesting. FBND's dividend climbed 5% over 3 years. Solid proof that rising rates actually boosted income for bondholders here. In plain English, SCHP's dividend collapsed by 36%, like watching your paycheck shrink month after month. Meanwhile, FBND investors saw theirs grow 5%. One balloon deflated, the other inflated. Let's break this down further. That 0.33-point difference means SCHP saves you over $6,000 versus FBND on $100,000 over 20 years. In plain English, think of compounding costs like couch change. SCHP loses a few coins here and there, while FBND loses a steady stream of quarters. After 20 years, FBND's couch cushions are noticeably emptier. Let's break this down further. SCHP bounced back in 747 days, while FBND took 1,050 days. That's nearly 10 brutal extra months watching your money stay red. In plain English, SCHP let you come up for air after 2 years, while FBND kept you submerged nearly 3. That extra year underwater feels like an eternity when you're nearing retirement. Now for the real question. SCHP's dividend dropped 36%, crushing income retirees. FBND grew dividends 5%, keeping your purchasing power protected and predictable. In plain English, think report card grades for your dividend income. SCHP's 36% drop over 3 years? That's failing badly. FBND's 5% improvement? Solid A. One forces budget cuts, the other funds your next vacation. Here's where things get revealing. The verdict's in. FBND delivers superior income at 4.7% yield, while SCHP wins on rock-bottom costs at 0.03%. In plain English, FBND's your versatile egg basket, carrying more variety and better income. SCHP's the single-purpose basket, cheaper to carry and laser-focused on protecting your eggs from inflation's heat. So which fund fits you? SCHP for inflation protection or FBND for steady income? It all depends on your goals. In plain English, SCHP's your low-cost play for inflation protection, while FBND offers steadier income with higher fees. It's the egg basket approach. Choose where you want your eggs based on what you're protecting against. Let's take a closer look. Standard disclaimer here. Do your homework and consult professionals before investing in anything. Now here's where it gets tricky. If you want weekly deep dives on bond funds that actually move the needle, hit that subscribe button now.